Swayam Prabha. Digital India. Educated India.
There are various forms of business organizations out there, and I'm going to be more dealing with the corporation part of it. Typical sole proprietorship, one man organization. Partnership, there are general partnership, there is limited partnership. Limited partnership, liability part of it is limited. General partnership, forming to sort of work on a business, etc. Let's not get in details into it. Typically, I am going to focus more on the corporation, the public company, the listed entity out there, the public company out there. That is what we are going to work on. And that is where this particular organization structure, what I talked about, works out there. The corporation is essential because they are the ones who are going to keep interacting with what we call it as the financial markets in this case. They are the ones who are going to keep interacting with what we call it as the financial markets in this case. Now, why is this financial markets? I have got the slide beautifully explains this. There is a huge, big investor pool which is sitting on the right in green out there. There is a small pool of what is called as a firms out there. Firms have to raise money. What do? They issue equity, they issue debt instrument. These equity and debt instruments are bought by whom? Are bought by the you and me, individuals, investors, private, etc. institutions out there. We buy. And then what happens? We buy that and we pay money. That is where money goes. The arrows you can see out there. This entire transaction happens through what we call it as the financial markets out there. That is what you call it as typically the NSCs and BSCs and everything, SEBI and all those, they're all involved, regulatory body which is SEBI and so on and so forth out there. So, the corporations, when they raise money from a public source. When they raise money from a public source, then what happens? The market gets involved out there. Now, what is this Bob and Sue and secondary market? Investors also have, once they buy it from the firm, the stock or the bond, the equity or the bond or debenture, I can sell it and make money. When I sell it, I am not selling it back to the firm, I am selling it within the other investor groups out there. That is where the investor pool is very big, as you can see on the right. There are millions of investors out there. I want to get out of the investment, I will sell my investment and another investor, potential investor will buy it from me. So, what happens? The transactions keep taking place between, and these transactions happen between investors through what is called as a secondary market, which is what in India we talk about NSC, BSC, etc., etc. I can sell as an investor on the exchange, and you can buy it on the exchange, and that is what typically happens. That is why I put two names out there. Bob sells it, Sue buys it, and so on and so forth out there. Instead of Bob, it can be any name out there. So, financial markets, the key is basically the firms raise money through the financial markets. Initially, the first time they raise money through the primary market. When I say the primary market, they are issuing the shares through an IPO or something, you subscribe to it, which is monitored by regulatory agencies and so on and so forth out there. Once that is done, they go about and list in the secondary market, and you as an investor are free to buy and sell in the secondary market out there after the IPO process. Moving on, we talk about cash flows between firms and financial markets. Typically, we have depicted the entire interactions that will happen between a firm and the financial market in this slide out. Let us go one by one. Investors with the help of financial markets, the primary market, invest money in the firm. That is why you see a cash for securities issued by the firm. That is money from the through the financial markets by the investors. They invest in the form of equity, debt, whatever it is. Through the financial market, primary market is the financial market. Invest money into the firm out there. That is where cash gets into the firm. Now, what does the firm do with that money? The firm invests in assets, fixed assets, current assets, whatever is the kind of assets out there. And then continues to operate the firm. They invest in the fixed asset and then they basically continue to operate the firm. Now, what happens? When they operate the firm, there is a resultant cash flow that will accrue in the firm out there because of their operation, because of the utilization of the money that people have given. I will repeat. There is a cash flow that the firm will generate by utilizing the money that investors have given to the firm through the financial markets, the primary market. The investors provided money to the firm through the primary market. The firm invested in fixed assets and that investment in the fixed assets has generated some cash flows, that is operations. That is what you call it as the C aspect out there. Now, that cash flows when the firm has generated, it has multiple options. If it is a debt instrument, there is obligatory that they have to pay what is called as the interest on the debt out there. So, the cash outflow, that is what you see F. But if it is not debt, it is equity, the firm has an option whether to pay dividends or not to pay dividends. That is why we termed it as F last. If it pays the entire cash flow as dividend, fine, dividends are paid, dead and gone. If it pays only part of the cash flow as dividend or does not pay any dividend, what happens? The cash flow gets back into the firm in the form of retained earnings. That is, the cash flow becomes the equity's capital which gets into the firm again. As you can see, the alphabet E there gets back into the firm out there in the form of retained earnings. Sir, you missed out an aspect D, don't worry. Moment they generate cash flows, which is profit, D, government will come and take their share out of it. So, that becomes mandatory in that case. Even if they don't pay dividend, even if they flow the cash back into the company itself, government will come and say, now here is my taxes, now basically pay out and then take out. So, what happens? When you talk about a corporation, investor, public, largely interacted, largely what is called as interact with it. Government, stakeholder interacts with it. Now, these are the basically what do you call it as the avenues in which the money will move. Money moves from the primary market to the firm. Firm invests in current assets. That results in cash flows. The cash flows can be used to pay dividends and interest, or can be flowed back into the firm. Of course, the tax part of it also gets out. That is what we have tried to depict in this form, in this slide out there. So, that is how it interacts between the financial markets out there. The cash flows between the firms interact between the financial markets. Now, having said this, the entire interaction part of it, what is the goal of financial management? What is the goal of financial management? Correct goal, appropriate goal. Number one, maximize profit, minimize cost. Obviously, if you have to maximize profit, you also have to minimize cost. Third aspect, maximize market share. Have a large market share. Fourth, most important, maximize shareholders' wealth. How do I maximize shareholders' wealth? I have huge cash flows, ensure the price in the market have huge cash flows, ensure that the price in the market is also of the equity is also moving considerably high and logically high, not a bubble, which is based on the performance. That is, if I perform better and have a potential to perform even better, the price in the market is going to go up. I am maximizing the shareholders' wealth out there. So that becomes the core goal of any financial management or financial manager out there. So in short, what is the correct goal out there? That's what I said. Out of these, all these four are important. I don't deny that. All these four are important. But what are the key aspects out there which encompasses all these three is the last aspect out there. So if I have to say what is the correct goal, the last one, maximizing shareholders' wealth, is the correct goal, because how will the shareholders' wealth be maximized? Only if you have a large market share, only if you have a large profit, only if your cost is low. So though I mentioned all these four, and all these four are important, the last aspect, if I say the core, the correct answer, which will encompass all the other three also. The next aspect what we look at, capital structure. What is this capital structure in finance? A very important aspect, capital structure. As I said, there are sources of fund. We went back couple of slides back, we talked about we talked about in this particular case debt and shareholders equity. Long-term debt, when I say, can be of multiple types of long-term debt out there. There can be multiple types of long-term debt. There can be, I can issue a bond, I can issue a debenture, I can raise money from a bank, I can raise money from a financial institution, I can raise money from a financial institution debt, I can raise foreign currency loan, whole lot of things. Equity, I can do a private placement, I can get an HNI and ask him to invest, I can go in for an IPO, all kinds of things. Now, what is the question? The question is objective. Number one, raise money in the best possible way, raise money keeping the cost at the lowest. So what combination is going to give me the best possible, what do you call it, as the capital structure for me? What combination of this debt, equity and various kinds of debt and equity is going to give me the best possible, what do you call it, as the capital structure? Optimum capital structure or the good capital structure will enhance the value of the firm. Why? Because the cost of raising the money is going to be lowest. If the cost is the lowest, then the value, as you saw in the previous slide, minimize the cost. If I minimize the cost, maximize the shareholder value out there. So I minimize the cost out there. So what is the objective of every financial goal of every manager? This is that's what you see, a circle out there is the pie, the capital structure, or what do you call it, as the value of the firm out there. Now the goal of every financial manager is to increase this value, that is increase this pie out there to bigger and bigger and bigger out there. By when he says bigger and bigger, it is viewed from the capital structure point of view. Should I have debt and equity, 50% debt, 50% equity, or should I sort of slice it very differently, in the sense, should I make it 75 equity, 25 debt, or whatever is it? Should I make it 30 equity, 70 debt, whatever it is? How do I slice this pie between various? Now again, I said debt. There can be multiple kinds of pie. There can be further slices. Here I have shown only two. There can be half a dozen more slices in this. So how do I slice this in a way where my cost is low, that leads to increase in the value of the firm? That is what we talk about as a capital structure decision. We will study this aspect in this particular course at the second part of this course. Now, what is when I said, what is the best possible, what could be the best possible capital structure, how do we decide that, etc. We will go ahead. So, in the next session, what are we going to do? We are going to talk about something called as the time value of money. Let us, what is time value of money? Where is it required, etc. We will sort of understand as we go along. Let me start with a simple example. Supposing I invest about 1000 rupees in a particular investment out there. 5 years down the line, that investment is giving me 1000 rupees back. Should I be happy? Should I be unhappy? You'd say unhappy. Why? Because of a very simple reason, that the object that I can buy using the 1000 rupees today, I will not be able to buy the same object 5 years down the line using 1000 rupees out. The value of that object would have, cost of that object or value of that object would have gone beyond 1000 rupees out. Why? Because with time, the value of your currency or money is decreasing purely because of inflation and so on and so forth. So, time value of money, if I have to put in one sentence, the good that you can fetch today using a sum of money, you will not be able to fetch the same good 1 year down the line with the same amount of money what you have got. So, what happens? You will have to pay a little more. So, in short, I invest $10,000 in a particular project. The project is going to give me, I invested $10,000. The project in the first year is going to give me $3,000. Second year, it's going to give me $4,000. Third year, it's going to give me about $3,000. So, what happens? 3 plus 4, 7 plus 3, $10,000. Is it worth investing? No, because the value of that $4,000 what I am going to get next year will be lower as of today. The value of what you call it as $3,000 I am going to get at the end of third year is also going to be far lower of today, because the $3,000 today and the what you call $3,000 3 years down the line will not be the same. In short, I will take even a simple example, even simpler. $10,000 I invest today. 3 years down the line, I will get back $10,000. $10,000 today is worth much more than the same $10,000 3 years down the line. Okay. So, time value of money. With time, the value of money keeps decreasing. That is all what we are going to talk about. We will talk about in detail in the next session.